Welcome everyone for joining us for our Critical Leaders Group. As most of you who we had been in touch with for this session know, the idea here is to create like a community of senior leaders from a range of companies, range of sectors, and essentially bring all of us together on some regular basis, quarterly or 6 months. We'll figure out the frequency based on everybody's calendars, and essentially bring some key topics which essentially are top of mind for all of us as leaders, CEOs, board members, and investors in the various sectors of the economy. We are doing these virtually right now, but the intent is over the second half of this year, try to get them to be in-person sessions. So it'll be great to see everybody in person and have a more intimate setting than what Teams might allow us to do. But again, appreciate everybody joining us for today's session. The group today for CLG is nearly 60 people, and there are 60 CEOs, senior leaders from a range of companies from the industrial and the technology sector, as well as consumer sector today. And the list keeps growing as you folks be a part of this forum and you see the level of discussion happening, and there are other executives we think you should be adding to the circle. Please do let us know. But our intent here is to, as I said, create a tight-knit community, discuss topics which are of common interest, bring expert opinions to the table, and then hopefully everybody finds the interaction constructive and valuable. So with that in mind, just wanted to give you a quick glimpse of who all are a part of the CLG circle today. These are all the companies which are there on the roster already, and they're close to about 50 companies today. Given the number of people, we'll not do introductions right now, but we have some times left for breakouts towards the end, and we'll make sure that folks are at least introducing themselves to each other at that moment and hopefully making their own connections. And you can see the companies are leading companies in a variety of sectors in the space, from ranging from industrials to semiconductors to consumer. And we are hoping that diversity kind of brings some interesting topics and interesting perspectives to bear as we get going with some of these discussions. Here is a quick snapshot of today's agenda. The topic, I think, as we polled most of you, the raging topic which came to the top of mind was what's happening with the economy, what's happening with inflation, what's happening in interest rates, and how will that impact business for all of us going forward, and how should we react? So today, I'm going to start off with some quick comments from our research around what has happened primarily in the past when we have seen such environments. But I think I'm most excited about welcoming Professor Hank and Professor Lakal with us today. I think they are renowned experts in their fields of economic projections and what will happen gazing into the crystal ball. And they're kind enough to spend some time today to share their perspectives about how to think about what's going to happen in the future, and gives us a good chance to pick their brains about how to assess where the dice might fall in terms of recession, deep, shallow, long, short. So this is a good chance for us to kind of ask them all those questions. So without any further ado, I'll get into a little bit of the early remarks, and then I'm going to hand over the virtual mic to Professor Hank and Professor Lakal as we get into the session. So we at INA, I mean, as you know, we are focused on primarily the industrial technology sector, and we spend a fair amount of time just from our perspective trying to understand what's happening in the market, and essentially less being experts about how to predict what will happen in the market, but more about if the market takes a particular turn, what's the best way to react. So essentially what we had done over the past few months was take a look at what type of indicators are we seeing where the economy may land over the next few quarters, and then B, assuming it goes a little bit more towards the recessionary side, what can we learn from prior lessons which could help us prepare our companies for a better outcome during that period. So I won't spend much on time here. There's plenty of data which is obviously going around, which talks about where inflation is headed and where interest rates are headed, and what is that doing to the liquidity in the economy today. I think we've all seen obviously what's happening with interest rate hikes and what kind of pressure it's putting in terms of balance sheets for several of us as we kind of start this year and look at demand profiles. The demand profiles are getting impacted by inflation, and their outlook looks weak as well. So there are what we are calling just indicators of recessionary storm clouds gathering. And I'm not the expert, and we'll pick Professor Hank and Professor Lakal to kind of get their opinion on this. But instead, what we started spending time on was within companies, how are people feeling and what is the right way to react? There are plenty of sentiment surveys out there. They all point to the same point of view, where if you look to all the CEOs and CFOs in top companies, most of them are planning for some sort of a recession to hit this year, whether it's brief or shallow or whether it's deep. But there is expectation that there will be recessionary headwinds in this space, in the various sectors we are playing in today. So what we did was we tried to say that, hey, let's not figure out can we predict it better or not, but let's figure out, in case something like that happens, what can we learn from prior cycles of people who had done well in this space? So with that in mind, we looked at the prior period where we started seeing at least low liquidity in the market today. And that was the more 2007 to 2012 period. And if you just take a step back in that session, we saw that industrials and various other sectors performed basically at about an average. If you look at this particular chart on top, from materials down to consumer staples, and barring real estate, virtually everybody saw middle of a pack kind of performance as we looked at both shareholder returns as well as what valuations they were getting from the market. But when we looked at it at a level deeper, what we did see was there was a tremendous amount of dispersion and disparity between the players who did well versus didn't do well. This is just an industrials example where what we did was we looked at about 470 industrial companies, and this includes semiconductors, this includes some of the photonics companies. And we basically said, hey, what is the difference between folks who did well versus who didn't do well? And the difference is actually tremendous. Like the bottom quartile performers delivered about 5% TSR in that time period, while the top performers delivered nearly 50%. So about 47 percentage points difference in performance. Then we also took it a step down to say that, hey, that's overall industrial. So maybe certain sectors did better than the others. And that's what the tailwind headwinds might have been. But when you break it down by micro verticals, and we're showing just 4 as a quick example, but this theme was true across micro verticals. There was a significant disparity between people who did well versus people who didn't do well. So which begged the question as to what was so different about the folks who were closer to the 40, 30, 50% CAGR delivery in that time versus folks who ended up seeing erosion in shareholder value at the same period. So when we dug in, I won't take the time today to kind of dig into specific companies, but a few themes kind of came up as you looked at their particular actions and what did they do both leading up to the recessionary period and coming out of it. And essentially, they were in two pieces. One was just is playing defense. We called it recession resilience. Most of these companies, just when that period of low liquidity was about to occur, started taking actions on both the balance sheet as well as their P&L, which gave them a higher operating leverage and reduced their debt burden on the balance sheet. So it's interestingly to see, like, just if you look at some of the companies who made the top of that scatter plot, they were taking actions 4-6 quarters ahead of that time to start entering into that period to be a lot more leaner, both from a P&L perspective as well as a balance sheet perspective. That included what we call operating leverage, which is taking your cost base and trying to make it more variable and less fixed. Talked about working capital to make sure there's a healthy cash conversion cycle, and then also just optimizing the cap structure to limit the debt as a source of funding. Well, that I think felt in many ways, very obvious to do. The other interesting thing which at least came up as we started digging into these companies was they also played offense at the same time. And by that what I mean is that there were 2 sets of actions they launched very explicitly, which made them in fact take advantage of that period as valuations came down, as certain assets became in the market where the financial case to work on them made sense. So there was a fair bit of acquisition these companies ended up doing during these times, and there was a fair bit of consolidation they drove in their particular micro verticals. And the second thing was also investing in their products and services at that point to make them a more higher value add differentiation for their customers and what we call quality of revenue. So it was interesting to see that there were companies that did just one. They did okay during the low liquidity period, but it's a company who did both one and two together, where they really were able to drive much higher shareholder returns in that period. So we again took the peel the onion one more layer down, and essentially it came down to looking at these 5 practices and trying to break down how did they do it. And this page kind of encapsulates a little bit of the type of actions we saw some of these companies take. So on the operating leverage side, they were doing better pricing, more granular pricing. They were spending time on discretionary spend control. We see now how much of an issue we're having with inflation and supply chain. So there were clear actions they were taking in both what we call hold the line and close the loop. So hold the line, making sure that they are very clear about which commodities or which SKUs they're seeing inflation on, and is that reasonable? And then most importantly, if you are seeing inflation on your inputs, how are you able to put that feedback loop back into pricing so that there is limited or as low risk as you can take from that particular inflationary pressure. Working capital involved, focusing on obviously AR, AP, and really rationalizing inventory, both in terms of what SKUs you hold inventory in and also where do you hold inventory in the supply chain. And then obviously on the debt side, looking at both CapEx decisions as well as just the structure of their cap table and figuring out how to optimize it. On the offensive side, these are the companies there. If you look at it, they start investing in practices like value-based selling, practices like aftermarket penetration. So looking at the install base and understanding where do they have differentiation to be able to really make a big push for revenue in that time, because candidly, everybody, including their competitors, is struggling with the same environment, and is a good time to kind of make that move. And then on the portfolio piece, these were companies which, if you looked at how they were organized and how they were operating, had what we call the programmatic M&A approach, which was even leading into these recessionary or low liquidity periods. They had a list of targets already in mind. They were already in many ways in the market, in the know for the type of companies, the type of capabilities or IP they're looking for. And as the conditions hit and valuations became more rationalized, gave them a chance to move on those targets. And at the same time, many of them, just leading up to that period, also trimmed their portfolio. So several of them invested in divestitures and made sure that at least leading into the period, the businesses they were working on were as quote unquote core as possible. And it's reflective in the metrics, right? So not just the practices, but if you look at their operating leverage, if you looked at their fixed cost, if you look at their people to non-people cost, look at their cash metrics, look at their net acquisition metrics, I mean, it becomes pretty clear that the actions they were taking were actually really delivering both balance sheet and P&L impact, which then resulted in shareholder value creation. So we at INA, what we did was we said, hey, as we look at our clients and our portfolio companies and thinking about what's coming up, our team essentially came up with what we call the Recession Resilience Index, RRI, which essentially tries to encapsulate all these metrics into a single variable to give us a language to discuss how ready or not so ready we are for recessions. So you see a little bit of the statistical scoring on the right-hand side where we build the model on prior data. And it talks a little bit about just the correlation. It's about 48%, which against given correlation of pure margin and revenue growth to TSR is in the 30s range. We felt pretty good about the fit. And it gave us a way to essentially look at, as I said, our clients and our portfolio companies to assess where are they good and where are they not so good in their recession resilience. So here's just an anonymized example where we looked at where our companies are faring well, whether it's in terms of revenue growth or portfolio, versus potentially in this case where they're not faring so well in terms of operating leverage or working capital. So again, gave us a way to at least understand how ready we are, and then specifically under that evaluation, what part of our readiness felt good or not so good. So with that in mind, we just want to leave you with a few questions, which as you guys think about your organizations and where they're particularly headed. I think on the top couple are mostly around how prepared you are, and then more specifically, what part of your recession resilience you feel is ready and fortified versus which part is not. I think that is a critical area as we would advise companies to kind of focus on. And then the second piece is not just the readiness, but then how are you keeping a pulse on the market and the industry to understand what is actually going to happen, right? So, what are the leading indicators you are watching for yourself and for your segment? And then, as importantly, for your end customers or the customers' customers who you're serving today, to understand at what point do you make the call that hey, we are going to go in for a shallow or a deep recession, and what actions do you come out of that from that sense? And then obviously we can't forget, given what all is happening around us with the banking disruptions, supply chain disruptions, geopolitics, are there other disruptions you are tracking which essentially impact your